The inventory offset account in QuickBooks is a bit of a nightmare for some people to deal with, and I totally understand why. In this video, I'm going to show you what it is, where it comes from, and yes, how to reconcile it, which you can do, and you totally should do it because it's not that hard. First, let's talk about where this account comes from. If you have enhanced inventory receiving turned on in QuickBooks, you will get this account automatically created for you. You can see if this is enabled on your account by just opening Preferences, go to Items and Inventory, and see where this yellow arrow is pointed to. If it's enabled, well, you're stuck with it. There's no turning off EIR. More details on that a little bit later. Here you can see with EIR off how the inventory asset account is going to be a debit and the accounts payable is going to be a credit. So this is the standard workflow for a bill being entered. And just a note on bills is that all a bill is, if EIR is off, is a item receipt that has been converted to a bill. So it's like a checkbox or a toggle in QuickBooks. If you have EIR turned on, this is going to be split into two different journal entries. So you can see here at the top, the item receipt has a $10,000 debit to inventory asset account, whatever that account might be, and then a $10,000 credit to this inventory offset account, the account we're talking about in this video. Subsequently, the bill is going to debit this same liability count and then credit accounts payable. So whereas before it was one journal entry, now it's two journal entries because the item receipt and the bill could happen at different times, and so this needs to exist an offset account to show you where the money is in between. So let's look at these transactions, the item receipt and bill, and see how it affects the journal entries and the inventory offset account. Item receipts posting to the inventory offset account are going to increase or credit that inventory offset account, whereas a bill is going to debit or decrease the inventory offset value. Think of it as the item receipt is you have something but you haven't paid for it yet. So if you just have the item receipt in there in QuickBooks, it's going to show up as a liability, which kind of makes sense. You've got something, haven't paid for it, it's a liability. And if you just have a bill in QuickBooks, but you haven't received it, it's kind of like you paid for something, but don't have it, so it's like a negative liability or really an asset, which means that if the inventory offset account has a positive balance, it could mean that you are receiving items in QuickBooks before you're getting the bills for them. And conversely, if it's a negative balance, it could mean that you're getting bills before you enter item receipt. Now, if you post-pay and prepay often for various vendors, this isn't going to really mean much to you. You could have a negative or positive amount at any given time. Lastly, item receipts are entered in the transaction level into the journal, whereas the bill is entered at the item level. This will make a little bit more sense in the next part where we actually look at QuickBooks and do one of these transactions. So let's look in QuickBooks at the chart of accounts and find this inventory offset account. It's an 88,000 account, which is made automatically when you turn EIR on, and you can edit a few things about it. So if you go in there and you edit it, you can change the number and the account name and some description information, but you can see it's locked to other current liability because this is an automatically managed account. So a common question about this is, should this account have a balance? Should it be zero? What's the deal there? Well, it kind of depends on your company. So if you're doing inventory rarely, maybe a couple POs a month or something like that, and you receive items fairly quickly after you get the bill or vice versa, you might actually see a zero balance in this account. If you have a lot of transactions in your company per month, it's unlikely you'll see zero balance on this account, which begs the question, how do you know everything's okay? What do I look for when managing this account? And that's exactly why you want to reconcile it, for the same reasons you want to reconcile a bank account. But unlike a bank account, you don't have a statement to go against. So let's look at what this process is. But before that, a quick shout out to the two sources I got for this process. On the QuickBooks forums, a woman named Susan has been extremely helpful about this process, and I was able to learn a lot from it. And I will link this in the video description if you want to check it out. And on YouTube, there is a channel called 4Lane. She goes into some good detail on this account and a couple other thoughts on reconciliation. You can find that link here or in the video description. All right, let's get back into QuickBooks. So if we open this account in reconciliation mode, we'll see that we have a statement last reconciled on 7/7. I'm going to reconcile to the same day, but you can imagine that you could do this weekly or monthly depending on your volume, so you can kind of see if there were discrepancies and find out what period that went wrong. This account can be huge, and if you've never reconciled it before, it might take a bit of time using this technique and perhaps others that you work through with your CPA to solve. In this demo, I have a lot less transactions to go through, so we're going to pick July 7th. And since you don't have a statement for this account, it's just going to be reconciled to zero balance. So we're going to type 0 in there and click continue. And this is what we get for this small time period. So this is a bit of a simplified version of this to make it easier to understand and to make it honestly easier for me to show. Before getting started, you'll need to make sure you have the right columns displaying because payee is very important in this scenario. So make sure those two are checked, and if you have memo, that's helpful too, you can use that. On the left, we have item receipts, and on the right, we have bills. Prior, I talked about how item receipts are at the transaction level, kind of the header level, and bills are entered at the item level, or the line level. So you can see on the left, vendor C has this $1,900 charge, but then on the right, vendor C has that $1,900 charge split into 4 items. So it's 4 items under one bill, but the item receipt gets entered at the header level. So you can see on the right-hand side, there's usually gonna be a lot more unless you have 1 item per bill. And so the theory here is pretty straightforward. You kind of sort by payee on both sides. You can select the first vendor and then select all of them for vendor A, in this case, all of them. Sometimes you'll have a couple vendor A's and a couple on the right, but you can use the date to help sort that out as well. And then move on to the next one, vendor B, grab vendor B. This is just a single item. You can see the difference is still 0 at the bottom. And then vendor C, and you can select those items right there. Now you can see I didn't select the final item, so it shows a $383 difference, but you can check all of them and it should zero out. Ultimately, you're going to be left with a lot of other transactions in here that don't quite zero out. Either you have the bill or the item receipt, but not the other side. And in that case, you just leave them in there and you click reconcile now. But before we actually reconcile it, I want to look at a report that's very helpful. I've already created the report, but I can show you what you would do to build it yourself. So we have this memorized report for inventory offset account, and it's the audit report that I've built for this scenario. So in this report, you can see that it's grouped by vendor, and it shows the balance for each vendor. So for any vendor that has a $0 balance, you know you're probably going to be able to line all those up and hit them to match each other on that reconciliation report. You can also see right here that it's starred because it's being cleared, but it hasn't actually been cleared because I haven't saved that reconciliation report. But this is very helpful to find out if you have issues, things aren't matching up, you can go into this report and check it out. To make this report, the following settings need to be done. Typically, you'll do all dates. For this demo, I did custom. You can select the columns that are helpful for you, total by vendor, and then filter out a couple filters. So account is going to be inventory offset account, of course. Cleared is going to be no, date all, and then in my case, I'm filtering for this demo. So you wouldn't need to put a name filter in there, but you could put other filters in if you want. So let's go back to that reconciliation and reconcile it now. We'll close this out and let's go back in and try to reconcile it again for that same day. And we'll see that those ones are all cleared out. Yeah, so those are cleared out, so we know that this particular time period is good to go. So yes, enhanced inventory receiving does come with a lot of pitfalls and challenges and extra work just like I showed you. But managing this account correctly is going to be really important in order to catch discrepancies with your inventory. Those are the kind of things you want to catch early on so that they're not found months or years after the fact. And that's all I've got. If you've got questions about QuickBooks Desktop or anything else related to this problem, post them below. I'd be happy to answer them. If you're looking for a CRM or automation options for QuickBooks Desktop, that's what my specialty is. So you can book a free meeting with me if you'd like at the link in the video description. Thanks for watching.